Our next guest says politicizing the Fed puts the FOMC in a no-win situation. For his insight on the Trump-Powell relationship, let's bring in Roger Ferguson, former Fed vice chairman, as well as a CNBC contributor. Roger, one of the things that, and it's good to see you, one of the things we've talked about is that the more you exert pressure on the Fed and Jay Powell to do something you want, it puts them in a position where it's less likely, might make it less likely that they would do it even if you hadn't said anything at all. I mean, it almost puts Jay Powell in a position where it would look like he was being completely political and appeasing President Trump if he were to cut. Even if he wanted to cut, he can't cut.
No, I agree completely. That's one of the sort of the catch-22 of this situation the president's in. You know, by the way, I don't think the data would suggest or support a cut right now anyway, and so that would even add to it. The flip side is if they do what I think they're going to next week and stand pat, that also seems to be a political statement. So it's really unfortunate, the events of this week, because it has created a dilemma for both the president and the Fed, I think.
Did you, I don't know if you caught much of we had Kevin Warsh, former Fed Governor Kevin Warsh, on yesterday. Did you catch any of that or read anything about it, Roger? Did you agree with any of his criticism of the Fed or analysis of the last couple of decades of Fed policy?
So I've heard your reporting on it. Look, I think the last couple of decades of the Fed policy are going to be under scrutiny. Look, one also has to recognize, though, that some of what has happened was very much the need to move to emergency efforts to stabilize the economy. I think there's a little bit of a critique that maybe the whole use of QE and QT needs to have a bit more of a framework around it. It was called into place as an emergency activity, and we've seen it's taken them a little while for them to, get their balance sheet back to the right size. So I think there are some questions to be asked, and the Fed is going to be asking those questions themselves. But it's always important to learn from the past so that one can improve the outcome of central banking. So if that's the approach that others are taking or Kevin's taking, I agree. It's a good idea to study what happened in the past to learn what worked and, most importantly, to learn what things to avoid.
I doubt whether Jay Powell or other members of the Fed think it's just a situation where you absolutely need to cut in July or near term. But if they did, this would be bad. This would be in a bad situation. Governor Waller seems to think that this is a good. He's been saying that for a while. I think the recent data, has that indicated to you that you friendlier about a cut at this point, or you still think they should stand pat and wait for data?
I absolutely think they should stand pat and wait for data. I heard the clip that you played from Governor Waller. First thing, most recent data has shown an economy that seems to be very healthy. Labor markets look to me like they are, roughly at full employment. Very importantly, the equity markets are continuing to rally. So financial conditions are loosening, so to speak. The dollar is weakening, which brings inflation into the economy. So I think all the signals that I'm seeing right now are stand pat. Not clear, how restrictive we really are. And so I would very much imagine, and I think most policymakers, based on what they've been saying, are not in a mind to cut at the upcoming meeting. We'll see if September comes into play. Even I'm a little skeptical about that as well. So I think Chris Waller, I respect him a great deal. I think his analysis, as he presented it the other day, perhaps is a minority view and maybe not yet the right way to move.
I don't know whether we've built it yet. I don't have it, but apparently the president, right as we speak, is making a post on Truth Social. You wanted to ask Roger?
Yeah, I actually wanted to ask you, Roger, about the Fed Treasury Accord, which Kevin Warsh brought up yesterday on Squawk Box, in order to sort of so that Treasury and Fed can work hand in hand in terms of managing the balance sheet and effectively, possibly, manage the longer end of the yield curve. And I'm wondering how you think that could work, and why isn't this done now or more recently than the 1951 Fed Treasury Accord that he cited? if it could possibly lower rates in the long end, reduce what we pay in terms of debt, and reduce borrowing costs for Americans as well.
So the brief history of the Accord in 1951 is that it freed the Fed from having to worry about the borrowing costs of the United States as it set monetary policy. That was an important part of what they had to do during World War II, but it turned out that it was hampering their ability to control inflation. Look, I would imagine that we shouldn't attempt to create a new Fed Treasury Accord with the explicit purpose of controlling the long end of the curve. If the Fed chooses to do that for good macroeconomic reasons, as we've seen when we've been in crises, that's a very separate analysis. But I actually think what we should do, generally speaking, outside of emergency moments, is have the Fed set interest rates focused on inflation and unemployment, and that mainly means the short level of the short end of the curve. The market then adjusts based on that. And then, the Treasury should get a clear market signal of what the cost is for running these deficits. So I'm not particularly in favor of trying to create a new Fed Treasury Accord that manages the borrowing costs for the United States. I think that's suppressing market signals, which I think is not a good idea.
President, I'm looking at the Truth Social feed. It's nothing really new, but he's just basically saying the Fed's too late. And now he's talking about the housing market. They're choking out the housing market with their high rate, making it difficult for people, especially the young, to buy a house. And then he goes on to say he is truly one of, so he owns it here, he is truly one of my worst appointments. And he talks about Biden. Sleepy Joe saw how bad he was and reappointed him anyway. And the Fed board has done nothing to stop this numbskull, which is it's Twitter friendly. If you ever have someone you really want to say something, knucklehead is
numbskull, yeah.
Numbskull is you can use on Twitter without hurt. And it says hurting too many people. In many ways, the board is equally to blame. The USA is rocking. There's very low inflation, and we deserve to be at 1%, saving $1 trillion a year on interest costs. I can't tell you how dumb too late is so bad for our country. Roger, like I say, not a lot new in that, but keeping the pressure on. I don't know how it does it. We're going to do this till May of next year?
I think we are going to do it till May, unless the economy weakens. The dilemma for the president, I think, is the one we talked about earlier. If the Fed cuts rates at this stage, I think it looks like it's very political. I think the reality is there will be a concern about inflation picking up. And in fact, borrowing costs for the United States will go up, not go down. Secondly, a 1% rate is an emergency territory. The president, if we get to a 1% rate, it means that the management of the economy has been pretty bad and we're back into some sort of crisis. So, I think the logic of the president's argument is not very strong. And I doubt that it's going to play well in markets. I don't think it's going to play well with the FOMC.